Hello everyone, and a very warm welcome. I'm Ian Dembinski from Rathbones, and I'm delighted to be hosting today's 30-minute third quarter investment insights webinar. I'm joined by two very familiar faces, Ed Smith, our co-chief investment officer, and Oliver Jones, head of asset allocation. Now, I know Jack Draper might be playing at Wimbledon, but I promise you these two will be giving him a serious run for his money in terms of performance today. A lot has happened since we were last on air. We've seen strikes by Israel and the US on Iran. Thankfully, so far, things haven't escalated further. Trade tensions are still bubbling, with the threat of tariffs hanging in the air. And closer to home, the UK government is balancing welfare cuts with its big pledge to spend 5% of GDP on defence, which, as you can imagine, is stirring up quite a lot in Westminster. The Bank of England is holding off on cutting interest rates for now, but will that change at their next meeting? That's a big question, especially for property markets. Speaking of property, Oliver has written a real page-turner comparing investments in public markets versus property. It's already flying off the shelves and is available to download right now in the menu on our webinar platform. So do grab a copy. It's the perfect holiday read for anyone lucky enough to be relaxing on a sun lounger. Finally, a special shout out to anyone who's just collected their young back from Glastonbury, sleep deprived, sunburned, and probably communicating only in grunts for the next 2 weeks. Well, that's my son at least. So there's a lot going on, but what does it all mean for markets and more importantly for your investments? That's exactly what I'll be chatting through with Ed and Oliver today to help cut through the noise. And here's where you come in. Send your questions through the chat anytime. I'll be keeping an eye on them using my trusty iPad. We'll also have a dedicated Q&A session at the end. We'd really love your feedback on this format. Let us know what's working and what's not using the feedback from that provided. Hearing from you helps us build a more engaging two-way conversation, not just a one-way broadcast. So let's get started. So perhaps, Ed, can I turn to you? At the last webinar, you explained that you thought an equity market recovery would happen pretty quickly after the tariff shock. That's indeed what's happened. Many markets have made new all-time highs. Do you think that recovery has been a little bit too quick?
Well, Ian, I emphasise that equity market recoveries could be very fast when you don't see significant signs of a banking crisis, broader debt market stress, or highly elevated odds of an economic or profit recession. And sure, markets and investors have been buffeted by news flows over Trump's tariffs, over global government fiscal largesse, and of course the Iran and Israel war. But all of those factors didn't combine to spark any signs of a banking crisis or a major debt market dislocation. And even when we were in the thick of the tariff uncertainty, when tariffs on Chinese goods were 145% before they climbed right back down, and tariffs on most other goods were well north of 10%, which is where they seem to be settling today. Even then, our subjective odds of recession only rose to 45%. That's the US entering recession in 1 year. Now they're back down to around about 1/3. So all of that combined means that I'm really not that surprised that we've had that quick recovery, as I suggested could happen last time. And I don't think it has been too quick. Now, for sure, we do expect a significant deceleration in global growth this year. The European and Chinese economies are still going to be pretty lackluster. And in the US, we do think we will have a gradual rise in the unemployment rate, and that will tamp down on the exuberance of the US consumer, which has made the US economy rather exceptional over the last few years. But all of those things combined means that it's really important to remember that a recession is not likely. Decelerating growth does not automatically lead to a recession. We've seen that many times. So when we bring this together into our investment strategy, we often think through a checklist approach, and we have checklists for factors that we need to see in order to go overweight equities, and checklists that we need to see to go underweight. And yes, there is all of this uncertainty around the world, but they are not combining to check off all of those factors that we would need to see to go to go underweight, which might surprise some clients. But yeah, there are a lot of positive things going on in the world. In the second half of the year, we may have more central banks doing rate cuts again. The oil price, which we may come on to later if we talk about Iran and Israel a bit more, that's actually lower than it was last year. And the tax bill that's going through the US Congress at the moment is about to impart some really significant incentives on US businesses to invest. Now, those things are not quite as salacious. Positive things don't generate as many column inches, but it's really important for investors to remember. So we don't think investors should be underweight equities despite the speed of this rally. And the positioning data tells us that institutional investors around the world could put more money to work.
So let's zone in on Iran. How do you think about geopolitical risks when investing our clients' money?
Well, regular viewers will know that we think about geopolitical tail risk through a robust and repeatable framework that we write up every year for our clients in a report called Peace of Mind in a Dangerous World. I know of no other UK wealth manager that has such a robust, repeatable framework that's written up for clients. So I really encourage everyone to take a look. The thanks to that goes to Oliver and his team. Now, the bottom line is that major geopolitical shocks, however profound the human consequences, tend not to have profound market impacts unless they impart a very significant disruption to the global supply of goods and energy, and goods and services. And when we look at the last 50 years, it's only ever really been shocks to the global supply of energy that has imparted such a profound effect. So when we think about what's going on in the Middle East today, I often find it helpful to talk to viewers who were around then to think back to 2003 when the US invaded Iraq, started the Second Gulf War. Now, the geopolitical and societal consequences of that are still being felt today. It was pretty profound, but the market impact was pretty negligible because it only took out about 1.5% of the global oil supply, and even then only for about 4 months before it was replaced by spare capacity from elsewhere. So the oil price moved up a little bit, but not much, and equity markets didn't blink. So let's have a think about what the oil price has done lately, because that really helps sort of explain why Iran and Israel conflagration hasn't moved. So this is a chart of the oil price going back to early 2021. You can see what happened when Russia invaded Ukraine, absolutely seismic consequences. But look at the far side of this chart, right? Yeah, if you hadn't been reading the news lately, you wouldn't know from this chart that anything out of the ordinary was going on with the oil price, with the global supply of energy. And that's because it hasn't. For all of the missiles that have been launched and bombs that have been dropped, the global exporting oil and gas infrastructure in Iran has been left largely untouched, and there's a lot of spare supply elsewhere in the world, even if it was. Now, there is the possibility that further conflagration could impose one of those rare major shocks on the supply of energy, but only if Iran closes the Straits of Hormuz, through which about between a quarter and a third of the global supply of oil and gas flows. Now, they would have to have the backing of China to do that, because almost all of Iran's oil exports go to China, and I think that's a significant geopolitical constraint. But it is a tail risk. It's one of those risks that we think about in our report, Peace of Mind in a Dangerous World. We have a strategy ready to put to work in our clients' portfolios if that tail risk does occur. And because we know, going back to 2022, that a lot of these, that if we do have a geopolitical shock, the impact isn't priced immediately. It actually plays out over many months. So if we have a jump on many other investors by having this framework and this strategy to put to work, then we are in a better position to safeguard our clients' financial well-being.
Excellent. So let's turn to you, Oliver. Now, inflation seems to be moderating, but the cost of living remains high. What's your view on inflation over the next 12 months, and what's the risk to that view?
Yeah, so worth starting with a bit of context. In the UK at the moment, inflation is 3.4%, so we're a long way from those highs of 2022, but still that's above the 2% that the Bank of England targets. Why is inflation where it is? Well, it jumped in April because of this slightly unusual combination of basically regulated prices increasing. So energy bills went up by about 6%, water bills went up by a third for some consumers. Also, the government put through one of the biggest increases in the national living wage, the national minimum wage that we've ever seen. Also, the change announced in the October budget, employers' national insurance contributions going up. So all of those things pushed inflation up from close to 2% to above 3%. The good news is those things are mostly one-offs. The changes that we see later in the year or next year in those things will not be as big, and that should help inflation in the UK head back towards 2%. Now, where there is a bit of a risk is on the labour market. So at the moment, wages growing at about 5% a year in the UK. That's probably a little bit higher than you would expect if you're going to see inflation overall settle at 2%, so it's something that the Bank of England watches very closely. We are seeing the labour market start to cool a bit. It seems like we're heading in the right direction, so reasonably positive picture on the UK inflation front, but a risk to watch there. Slightly different story when it comes to the US. Actually, the starting point is much better. Inflation there is very close to 2%, but what's coming down the track? Well, these tariffs that Ed mentioned earlier that have just been imposed, putting at least 10% on the cost of nearly all imported goods. Goods inflation, for context, is basically zero at the moment in the US. That's rapidly going to change. That could add a percentage point or a bit more to inflation. And then, again, to pick up on another theme that Ed mentioned, the budget bill that's currently in Congress being debated in the Senate. The tone of the debate on fiscal policy in the US is so different to the one here, where Rachel Reeves is really thinking about meeting her fiscal rules. What can she cut back to stay in line? That's not the debate in the US. Big tax cuts are coming through. Yes, some spending cuts, but not big enough to offset those tax cuts. So you'll see extra support for demand in the US, and that's also something that potentially contributes to inflation risk there.
So what path, given all of that, what path do you think the Bank of England is going to take in terms of interest rates? Are you someone who believes in one rate cut, two rate cuts in the next 12 months? Where do you stand on this? And how does it compare to the Federal Reserve?
So viewers should be able to see on screen now a chart which is showing you a really long-term history of interest rates, first of all, and then you can see the crosses on the right-hand side of that chart showing you markets' expectations for year end. So far the Bank of England and the Federal Reserve, they've followed a very similar path. They've both cut rates by a percentage point from their peak, and in both cases markets are expecting something pretty similar as well. One or two more cuts over the second half of this year. Now, in the case of the Bank of England, I think that makes sense given that inflation outlook that I talked about dropping back towards 2%. I would say that in the US, I think the risks are potentially skewed towards fewer rate cuts than markets are anticipating. And that's despite the news that we've had reiterated in the past few days of President Trump really trying to put pressure on Jerome Powell, the chair of the Federal Reserve, to cut interest rates. It's worth remembering that he did that all the way through his first term in office, and US rates actually rose quite significantly, so even more than what I'm talking about here.
So that could actually infuriate Trump if the rates don't come down. But Powell is safe, isn't he, until May of next year in terms of his tenure?
Yeah, that's right. I mean, this is an area that we've been thinking about quite a lot because there have been so many of these very high-profile comments from President Trump. I would remind viewers of two things. First of all, the point that I made a moment ago, Trump did this last time. This is not new, and the Federal Reserve did an impressive job of keeping on going, basically raising rates when it needed to. The other thing to say is this is not an area where the president has a completely free hand as he does in some other areas of policy. Again, when Trump was president previously, 5 of his picks for the Federal Reserve Board were knocked back, several of them by a Republican-controlled Senate. So it's not all in his gift, essentially. And in fact, there was a recent ruling by the Supreme Court, which in some ways has been shown itself quite accommodating to what Trump wants, but singled out essentially the Federal Reserve as a special, a different organisation to other government institutions with extra protection from presidential control over appointments.
Just a quick reminder to everyone to put your questions in the chat function if this is eliciting thoughts and comments from you. And also, this also links, of course, to property prices. And we've had, by popular demand amongst our clients, a lot of questions about the relative merits of investing in equity bonds versus property, particularly buy-to-let. And in your report, you discuss that, don't you?
Yeah, absolutely. We've just published this big report. I would encourage people to read it. A key point that we make in there is that in the UK, we love the idea of investing in property. It's like ingrained in our culture. Homes under the hammer.
Don't we?
Yeah, grand designs, etc. But that, I think, really stems from a time, an era that lasted, say, from 1980 up until about the mid-2010s, when returns from residential property in the UK were fantastic. Nationwide, the average house price going up by 6% or more a year, even more in London, rising by 8% a year on average. And bear in mind, that period had the global financial crisis in it. So overall, very strong period for property prices. But we show in the report that has really changed since the mid-2010s. So since 2016, nationwide, the average house prices only just kept up with inflation, rising just over 3% a year, even less in London, 1% a year. Why has that happened? Well, two things really. One, again, you can still see this long-term chart of interest rates. We saw a huge generational decline in rates from 1980 up until the mid-2010s when they were at the zero lower bounds. We're not seeing a repeat of that now. I talked to you about the possibility of 1 or 2 more rate cuts for the Bank of England. Makes a difference at the margin, but it's nothing like what we saw from the 80s to the mid-2010s. And then the other thing is house building. So it's very well known that in the 80s, in the 90s, in the 2000s, very few houses were built in the UK, but what is not widely appreciated is that's actually begun to change, again, since the late 2010s. So the rate of house building now is matching levels that we last saw in the 1960s, and the government, of course, wants to go even further. 39 billion of funding in the spending review for affordable house building, planning reform coming through as well. The government's got a very ambitious target, which it might not meet, but I wouldn't focus on that. What's more important is that house building is likely to keep rising.
But it's not just about the interest rate impact on property prices, it's also about the tax and regulatory environment that the UK government seems to be setting is unfriendly to the buy-to-let sector. Yeah,
again, it was really interesting to look back at just how much has changed for a typical buy-to-let landlord since the mid-2010s. So in 2016, you saw stamp duty start to change, 2017, the tax treatment of mortgage interest payments, and since then there's been a whole host of other things that basically make life more difficult for buy-to-let investors, continuing under the current government as well, following on from the Conservative government previously, all kinds of things from more stringent energy efficiency regulation to, in particular, the Renters' Rights Bill that's currently in Parliament. That will change the balance when it comes to evictions and rent reviews in tenants' favour. Now, you could argue socially that might be the right thing to do, but also makes life more difficult for buy-to-let landlords.
And Ed, just turning to you, we've seen increased volatility in the bond markets recently. What's causing this, and how should we be positioning ourselves in the fixed income market?
So we've seen the volatility be particularly pronounced at amongst longer dated bonds, 10-year government bonds in particular and above. Shorter dated bonds have been much more well behaved, and that really plays into a really high conviction strategic call that we have discussed on this webinar before over the last few months since last autumn. And that is when you are looking to build multi-asset portfolios and equities are your main growth engine, that's what's going to meet our clients' financial needs. The bonds that you have in there are largely to diversify, to smooth that journey to financial success. Now, historically, you may have put in longer dated bonds to do that smoothing, but today we want to put in those shorter duration bonds. And the volatility that we've seen this year really just reminds us, throughout a few episodes, why that is. The most recent volatility has been in part perhaps due to the Iran-Israel war, but much more clearly about concerns amongst some cohorts of bond investors about the US government running very large deficits, which Oliver discussed a moment ago. Now, in the last few days, actually investors have rethought that and bond yields have come down. Government borrowing costs at the longer end of the curve have come down. But we will expect to revisit those market concerns about fiscal largesse and therefore what premium investors demand to be paid to take the longer term risks related to that. What I think it's really worth reminding investors that the golden age of multi-asset investing that happened between the late 90s and 2022, when all you really needed were equities and a 10-year government bond, is behind us. Yeah. Because the relationship between equities and bonds is probably returning to the norm that prevailed for 180 years before the late 90s. And that is a relationship where that 10-year government bond and equities were more often than not positively correlated. Now, we had some periods of negative correlation in the 50s and 60s, a period of profound international relation change and international order building. At the end of the 80s, briefly when following the collapse of the Berlin Wall, and then again in the late 90s to 2022. Now, geopolitics wasn't the only thing going on there, but peace dividends and some of the lower risk premiums related to a more stable world order and the free trade and flow of capital that promotes is part of that picture. And today geopolitics is becoming more volatile, trade is becoming less free, you've got demographics, the green transition, fiscal sustainability, as I said, all causing the relationship between how both nominal and inflation adjusted bond yields behave and how they behave relative to equities to change. And that's why we want to take some of the risk out by looking more at the shorter end of bond maturities.
Now we have a blizzard of questions coming in, and actually handling which one to go first is a bit tricky, but one of our viewers wants us to broaden our view beyond the US and UK. And what is the situation regarding European economies, European assets, European interest rates, or even assets such as gold and commodities? Would you like to broaden out to those subjects?
Well, yeah, shall we focus on Europe?
Yeah, let's do Europe.
So I very briefly mentioned in my answer that the European economy is likely to grow at relatively lackluster levels this year. But actually, compared to where Europe has been for many years, actually lackluster isn't too bad, right? It's been a structurally weakened economy, now getting back to low but more stable growth. What has massively changed in the recent past is its attitude to mobilizing fiscal capacity. To issuing debt, whether jointly, federally, or through a unified program, but where debt is issued at the country level, to invest in infrastructure and defense spending. And the orders of magnitude of this are really quite incredible, to the point where actually it's going to be really difficult for them to spend as much as they say they're going to spend, at least in the first few years. Now, I make this point because one of the things that has made the US economy and its markets exceptional over the last few years is the propensity for the government to use its balance sheet to direct and incentivize capital, in particular, to parts of the market that are likely to generate high returns, whether that's economically or in terms of the profits that can flow directly from
Could that be defence, for example?
And that is defence and infrastructure spending. And that point has taken away one of those pillars of US exceptionalism and has made us quite excited about some of the investment opportunities that there are to be had in Europe, even if overall economic growth might not be particularly high, at least in the next 12 months.
Ollie, would you like to come in?
just to reinforce Ed's point, really. Every summer my team travel to Europe. We meet with policymakers, we meet with experts in industry, we meet with politicians, And this year, the change in tone was really remarkable. I remember being in Germany, in Frankfurt in 2022, and the tone, the mood was depression, basically. People in Germany were talking about the country's growth model being fundamentally broken. What were they going to do without cheap Russian energy? How are they going to cope with a more protectionist world? Just not set up for it at all. This year, complete change. In the former German Chancellor, Olaf Scholz, he talked about Zeitenwende. Apologies for my German pronunciation, but it means a turning point. And so many people in Germany talk to us about seizing the moment, essentially choosing to take control of their own destiny.
Yeah.
Ed talked about fiscal policy. Germany's gone from being Europe's arch fiscal hawk with the famous black zero, the balanced budget, to passing laws that will allow it to run a deficit of 4% of GDP, basically in perpetuity, to spend on defence and to spend on completely revitalising its infrastructure, a really necessary and important project.
And so if you take that in the round, have we shifted our asset allocation geographically at all recently?
Well, Ed mentioned it. We're looking for companies which tie into this theme, essentially. Europe both rearming itself, but also something much broader, which is rebuilding its infrastructure. In the 2010s, in the austerity years, this is something that was really neglected, more so in Germany than elsewhere. So we've increased our allocation towards Europe and looking for companies that particularly tie into those two important themes, because that's where the money's being deployed, and it's hundreds of billions of euros.
We've got a question, Ed, coming in about the US dollar. The Trump administration seems to be deliberately trying to depress the US dollar to help its exports. But isn't that actually quite good news for us, because sterling purchasing power should lead to then lower inflation?
Well, I mean, we don't import very much of our inflation basket, the goods that are in the inflation basket, from the US. So the direct impact of that is not likely to be very significant. A cheaper dollar can boost the competitiveness of American companies, particularly American companies that are exporting abroad. But you've got this difficult, complex relationship at the moment between the price of the dollar and the impact that tariffs may have on the supply chains of American companies selling overseas, potentially raising their input costs.
Now, we've got one of our viewers having an understandably dark moment. Are you ready for this, Ed?
Go for it.
So what impact would there be if China decided to invade Taiwan or Russia invaded Finland on our view of markets? I know it's difficult to predict, but we do have to manage geopolitical risks.
Well, the first thing I would encourage the viewer having a dark moment is to look at that Peace of Mind in a Dangerous World report, because actually China invading Taiwan has been one of those tail risks in there from the very beginning of this report. It stayed in there.
And Russia-NATO conflict now too as well.
And yes, that's right.
So we've been contemplating our own dark moment.
Yeah, quite.
Yeah.
So look, the consequences of those would, well, if we take Russia and Finland or whatever the conflagration might entail, that would likely be have a insignificant shock in terms of global commodity supplies, but perhaps not as profound a shock as last time, because of course Europe has become a little less dependent on Russian oil and gas, and that's become a permanent feature of the post-Ukraine world. China, Taiwan is, of all the tail risks we monitor, we are not. The reason we do this exercise is so that we are prepared. We're not in the business of predicting, because actually there's not much evidence that investors are very good at it. But if we did have to put these in rank order of likelihood to happen, and remember that all of these things are relatively unlikely to happen, China invading Taiwan is probably at the bottom end of it. We speak to geopolitical strategists, people involved with government and international relations, and actually a more likely path over the next 5 years or so, 5 to 10 years, is China retaking control of Taiwan, but actually not using forced to do it. There is a very large groundswell of support in Taiwan of China taking back control. If it did it today by force, for sure, the crown jewel of Taiwan's economic system, its incredibly advanced and very efficient abilities at producing semiconductors, advanced microchips, would almost certainly be sabotaged. In fact, it's actually an open secret, it's been leaked, that is the US's instructions to Taiwan,
deliberately destroy the chip manufacturing.
So actually, it's not really in China's interest to do that today. If it did, though, we've got that preparation. You can read about it in the report. It would be a very profound shock to inflation. It would be a COVID-like shock because it would disrupt supply chains in all sorts of different goods and services, so it would be highly inflationary.
And I had read also another report that they're more likely to apply the so-called boa constrictor approach of creating a blockade around Taiwan so they don't invade at all. It actually becomes very difficult for the US to break that. So there's lots of different things that could happen. The other headline that's happened, which is one of our viewers has pointed out, is Elon Musk vowing to unseat lawmakers who support Trump's big, beautiful bill. Is it a given thing that bill's going to go through, or could it get derailed? I don't know what your view is on it.
We don't know the exact form in which that bill will pass, but I think it's highly likely that it will pass. I think Elon Musk makes for fantastic copy for news editors, but I don't think he has the power to prevent this bill from passing. Interesting to think about what's in it for a minute. We kind of mentioned it briefly early on. Trump is extending the tax cuts that he passed when he was president previously. He's fulfilling some campaign pledges as well, so cutting tax on tips and overtime pay. Ed briefly mentioned some of the big incentives for business investment in there. Yeah. So if you're a business and you build a factory in the US, you'll be able to write it off straight away. On the other side of the coin, there are some spending cuts, particularly to things like food stamps and things like Medicaid that affect the lower income consumers in particular. But the overall effect of this is basically more stimulus for the US economy in the short term. It relates to points Ed made earlier on about why we're allocating to shorter dated government bonds rather than longer dated ones. Well, those longer dated ones, they're more sensitive to this kind of fiscal risk. The US continuing to run big deficits for the foreseeable future, which is basically what this bill locks in.
So if I had to blindfold you and I was to tell you so that you couldn't have any external influence that this government was cutting welfare and increasing defence spending, you might be tempted to think that's a Conservative agenda. And yet there's a big reaction from the Labour Party MPs against that agenda. Could you see Starmer's government being hidebound and unable to cut the deficit and the debt of this country, and therefore swing back further left? I don't know if either of you got a view on
that. The point that you've just made, I think, ties into basically a broader point that we kind of heard about from Ed earlier. It's like, how's the world changed since the 2010s?
Yeah.
One of the ways it's changed in the UK to a limited extent and to an even greater extent in the US and in Europe is that the politics of austerity has broken down. Politicians' commitment to reining in spending is weaker than it was in the past. That's something we've acknowledged and we are reflecting in our positioning, in particular what Ed talked about. How do we allocate to government bonds? Allocating to shorter dated ones rather than longer dated ones is a really important way that we reflect this quite profound change in the world, both in the UK and elsewhere.
Remember when Starmer and Reeves first came to power, they made these promises that just couldn't all be kept. They promised to do some very expensive things like sort out the NHS and build more social housing and fix the education system, but they said they weren't going to raise taxes in all of the most lucrative areas of taxation, and they said that they weren't going to take out much more debt either and get the debt to GDP ratio falling. Now, you could do two of those things. You can't really do three. And at the time, when we were writing reports on this, we said what's going to give. probably a little of all three. And the latest rollback on the welfare cuts suggests that there are going to have to be some tough decisions to be made come October. But as Oliver highlighted, the world's attitude to fiscal spending has changed. There are risks at the longer end of the bond market curve, but we think they are manageable for the UK. We're not staring down the barrel of a government fiscal crisis.
Now, there's an interesting question about how do ethics play a part in our investment strategy, because you could make an argument that it's time to turn away from the US markets and look further towards China and, say, India, with their larger populations, high access to technology, and their also relationships with emerging markets. But they have their own ethical issues in terms of investing in those markets. Where would you say we're positioned, Ed?
So we consider ethics, or we tend to think of them through environmental, social, or governance risks. We think of them insofar as they could have a financially material impact on our portfolios. Because most of our clients do not give us anything other than a financial mandate. They come to us with some financial goals, and we help meet those goals. Now, we have a wonderful business called Green Bank that, if people want to elevate non-financial outcomes to being as important or perhaps more important than financial outcomes, then they can run portfolios in that regard that have a bit more impact. We also have donor-advised fund services now as well, for the more philanthropically minded. But for most of our clients, we are only concerned with those ethics insofar as they present a financially material risk. And of course we take that into account. We spent a lot of time this year debating about what could happen if we have a breakdown in the rule of law or private property rights in the US, which a few years ago, even under Trump 1, was kind of really unthinkable. But now in Trump 2.0, perhaps it's not so implausible. We do think about the consequences. We draw on the literature about how this might have happened in the past. Of course, in the US, it's hard because there isn't an example, at least in the post-World War II era, of a country being at the technological frontier and of such a huge size and destination for capital, rowing back on some of these reasons why people like to invest in countries like the rule of law. But it is something we actively debate. Now, China obviously is a dictatorship. It's become much more statist in the last 10 years, increasingly so year after year. We've seen a very heavy hand in capital markets, pulling IPOs of giant companies, banning the private sector from certain sectors like education, wiping out companies. And those factors, again, they don't prevent us from investing in China. We have some small exposure there, but they do weigh on our outlook because they have financially material outcomes. India screens better on some of these factors. But of course, there's still pockets of concern. But India has a great story. It's done very, very well. It's likely to continue to do well. But the thing with India is that when we model, even for the most optimistic set of outcomes, it looks very expensive. Now, and value in emerging market investing is much more important than it has been in developed market investing over the last 10, 15 years.
Now, no program would be complete without a question on AI that's just come in. And I read actually in the last week that the major 4 accounting firms have cut their entry-level jobs by 35%.
Yes, I read that
because
too.
AI is replacing some of those jobs. I also read, and I don't want to alarm both of you, that one of the big banks has just taken their analysts and put them onto a system called Synthesis, which records their voice and face. And so when they write a research report, they can transcribe it down to a 3-minute video package, transmit it out. So there will be Ed 1.0, and then there'll be AI Ed 2.0, and there will be 2 of you existing in our organization. What a frightening thought. But I don't know what your view is on AI taking people's jobs. Shall I start with you first, Ed?
Yeah, sure. We've written about this over the last 10 years, actually. Obviously, lately in the context of generative AI, but before, when these concerns come around all the time. In fact, they date back to the Elizabethan era, right, when there were bills passed to prohibit weaving technology coming through because people thought they were going to take people's jobs. The evidence over hundreds of years suggests that actually, at least over the medium to longer term, they don't take people's jobs in aggregate. They take some people's jobs, they create new jobs because they make us more efficient. And that means that productive capital is freed up to flow to more productive parts of the economy. That creates new jobs. And if you think about it at a human level, AI is rarely taking 100% of someone's job. It's actually taking a lot of their tasks, but there are other tasks that are perhaps more value-added tasks that they can now have more time, that a person now has more time to do. Now, I would say that there's obviously a lot of hype around AI, and the adoption of using ChatGPT or Perplexity or these types of services has been absolutely phenomenal, and that continues a century-long trend in the speed with which society adopts new technologies. But what impacts economies in terms of their productivity growth and broad spread profit growth, and therefore potential job losses, is not just adoption, it's adaptation. It's not just using the technology, but changing your processes, reskilling people, changing how companies are organized. And that takes a little longer and seems to be taking longer at still in this latest phase. Yes, coders are now 55% more productive. Writers, it takes 40% less time to do a corporate writing task. There are studies of this, but the broad-based aggregate effects are still pretty muted. So those fears of job loss are probably a little unfounded.
Ed mentioned hype in this context, and it's so relevant. If you were to follow the media coverage alone, you would think that AI was invented a couple of years ago, but that's not the case. The innovation was generative AI, but even in our own work, we use bits and pieces of AI that in many cases were invented 20 years ago. Like, this has been a continuously developing thing. Natural language processing, large language models, they're all forerunners of the generative AI, ChatGPT, that has generated so much media coverage, but the process is more gradual, and that speaks to Ed's point. The impact on labour markets is real, but it's happened over time. This isn't the sudden shock that it's sometimes portrayed as.
And we're trying to harness the benefits. For 18 months now, we've had effectively an AI analyst as part of our asset allocation committee meeting. So feeding in signals to make the decisions that we make by looking at thousands of different data points from all over the world and trying to spot the sorts of non-linear patterns. So if X, Y, and Z, then that humans aren't very good at spotting. So we're using this tool to effect.
Well, I think you're both utterly irreplaceable, handsome and talented. That just couldn't happen. It just couldn't happen, could it? So sadly, we've run out of time. So we won't be able to take any more questions today. Do make sure to register for our next Investment Insights webinar taking place on Thursday, the 9th of October, and using the link provided within the webinar platform. If you have any comments or suggestions how we can improve these sessions or the topics we cover, we'd love to hear from you using the feedback form provided. Thanks for joining us. It's hot out there. Get hydrated, and wishing you a great afternoon. Thank you very much.